This is a Fatima Institute Center for CIFA Studies. Today we want to study Chapter 7 of Derivatives, Option Markets and Contracts. You can see what we'll be going through. That is the introduction part of it, types of options, characteristics of options, contracts. Some examples there. The concept of moneyness of an option, the structure of global option markets, over-the-counter option markets, exchange listed option markets, then options valuations, determinants of option price, option pricing models, sensitivity analysis, option premiums, principles of option pricing, payoff values, boundary conditions, the effect of difference in exercise price, the effect of a difference in time to expiration, put call parity, American options, lower bounds, and early exercise, the effect of cash flows on the underlying asset, the effect of interest rates and volatility, option price sensitivities, discrete time option pricing, the binomial model, the one-period binomial model, the two-period binomial model, binomial put option pricing, binomial interest rate option pricing, American options, extending the binomial model, continuous time option pricing, the Black-Scholes-Merton model, assumptions of the model, the Black-Scholes-Merton formula, inputs to the Black-Scholes-Merton model, the effect of cash flows on the underlying, the critical role of volatility, pricing options on forward and futures contracts, and an application to interest rate option pricing, put call parity for options on forwards, early exercise of American options on forward and futures contracts, the Black model, application of the Black model to interest rate options, then the role of option markets, then uses of options. Now, at the end of that chapter, you find revision questions from 2015 to 2024. Now, remember, this is one of our revision kits, derivatives analysis, which is under CIFA. Now, the key topic issues there you find is determinants of option value. Now, you say there the value of an option is determined by a number of variables relating to the underlying asset and financial markets. Some determinants you find there is a current value of the underlying asset. Number two is variance in value of the underlying asset, dividends paid on the underlying asset, strike price of option, time to expiration on option, and riskless interest rate corresponding to life of the option. Now, we have discussions there. We have explained how each determinant affects the value of option. And if you move to the next page, you find explanations there. That is how variance in value of the underlying asset affects the option price, dividends paid on the underlying asset, the strike price of option, time to expiration on option, and riskless interest rate corresponding to life of the option. So the explanations are there. Then the next chapter, or the next page rather, you find factors affecting option pricing. Each factor is given there. For example, the first one is increase in underlying assets value. How does it affect call options value and then the put option value. You can see the second column and the third column, the explanations there. Now, the other part of our discussion will be on the BSM model. The formula for the BSM model is given there. So you find here, this formula here is very important. The formula for the BSM model is given here. We need to understand what is S0, what is ND1, what is all this, what is all that. Now, D1 formula, you start by calculating D1 and the formula is there. Now, in your calculator, you find something written as IN. Now, that is natural logarithm. You can find it in your calculator. Then you have S0. The first S0 there means asset price. Then divided by X. X is the exercise price. Now, down there after the D1 here, you can see the explanations there, the meaning of each term used there. For example, ND1, S is current value of the underlying asset. This is this S here. This S here means current value, or the current value of the underlying asset. Then we have T here is the time to maturity, is a percentage of 360. You take normally the number of days given divided by 365, you get your T. So the meaning of all what you find here, you find explanations down here. Then the process of valuation of options using the Black-Scholes model involves the following steps. The steps are given there. That is step 1. The inputs to the Black-Scholes are used to estimate D1 and D2. The process continues up to step number 4. Another important thing that you find in our book is the BS model assumptions as well as limitations. Now, you find that we have given some, in that page, we have 3 assumptions or limitations here. Then the next page, what you find there is explanations of those limitations of Black-Scholes model. Now, the next page you find some examples, but let's focus on the example because that was the most important thing for our lesson today. The example of using the B as a model in calculating the value concern. Now you are told, then as an example there, you are told Professor Jones is a distinguished financial analyst for GH Limited International, a company dealing with highly expensive products such as meat and chemicals. He is interested in using the Black-Scholes model to value the call options on the stock. The following information has been availed to the professor in the year 2022. Number 1, the price of the stock is shillings 35. Number 2, the strike price is shillings 30. Then the option matures in 9 months. The volatility of the returns of the stock is 0.3. Then the risk-free rate is 10%. Required the value of a call option using the Black-Scholes model. Now our solution is here. We always start by calculating D1. So I told you that D1, the formula is given here. Now you take the natural logarithm, which you find in your calculator. Now if you take your calculator you find that one somewhere here. This is what I'm talking about, the natural logarithm. This one, I think you have seen this one, this part here, logarithm, the natural logarithm. So that's the part I'm talking about. Then this 35 here is the price of the stock, this one here. So take the price of the stock divided by the strike price, 30. 30 is a strike price. So 35 divided by 30. You take the natural logarithm for that. That is, if you pick your calculator and then you press here, this button here, and you pick that button there, then you put brackets, then you put 35, then you divide by 30, you get that particular section, or you get that particular number there, 0.15 or 150,679. You can use 3 decimal places or 4, and I think that is where you get this figure from here, 0.154. So that is this particular section here. Then you plus 0.1 plus into brackets. 0.1 is a risk-free rate, 0.1, the 10%, 0.1 plus 0.5, our formula you're using half. So 0.5 is our formula, so don't ask where 0.5 is coming from. This is just our formula. So you take the risk-free rate, the 10%, plus 0.5 multiplied by, now usually this is a standard deviation, but if you're given standard deviation, to get variance you have to square. So 0.3 is the volatility of the returns of the stock, is 0.3. So volatility, the standard deviation, you square that to get the variance, 0.3, this one, you square that, then multiply by time to expiration, 0.75. Where is that one coming from? Now you have 9 months. Point number 3 here, you are told the option matures in 9 months. So you pick 9 months, you take 9 months divided by, you take 9 months divided by 12, you get 0.75. 0.75, that is where this figure is coming from. Then divided by, remember our formula looks like 0.3, that is the volatility, then you multiply by the square root of time, the square root of this time here, 0.75. So you work out this, if you work out all this, now 0.154, we calculated this one before, you plus, if you work out this part here, you get 0.10875 divided by 0.2595, that is the denominator here. You should have gotten this one. So if you solve out this one, you get D1, the value for D1. Now, I want to get ND1 at this level. I want to get my ND1 here. My ND1, how do I get ND1? Now you should use a binomial table. Now you find that I got my answer as 0.84, 0.8438. I want to show you how I got that using my table. If your D1 is 1.01, now you can pick your table. If the examiner provides that table, I'll check from here. I have a table here. Now, I think we got our answer there is 1.01. I want to read that one from here. 1.01, I'll just go here. 1 is here. 1 is here. 1.01. You read from here. This is the standard normal cumulative probability table. So just go to 1.01. You read this one here. 0.8438. I think that is how we got that. So you have that table there. That's how I got that. The ND1. The ND1. That is how I got 0.8438. So I have my D1 by calculating it. I have calculated my D1. I have calculated my D1 here, 1.01. From this formula, starting from here, I got D1 as 1.01. Then ND1, which you find here, this number here, I've shown you how I've calculated that after getting 1.01. Then, after you get ND1, you calculate D2. You calculate D2 here. D2, the formula is here, D1 minus this one, square root of that. So D2 now, you just substitute D1, you have 1.01 minus this 0.3, you just substitute here. The square root of t we got 0.75. Actually, this section here is the denominator for D1. You just bring the denominator for D1 here. You lesser D1. So D1, you have it as 1.01. Then if you work out that, you get 0.75. So we want to get our ND2. If you go back to your table, you read 0.75. 0.75. We read our 0.75 from the table that we have. 0.75. 0.75. You just come here. 0.7. 0.7. 0.7. 0.7. You go to 5. Go to 5 here. 5 is here. So 0.7734. 0.7734. I think that is how we got that. That is how we got that 0.7. 0.7. This answer here, 0.7734. So you got your ND2. You get your ND2. So let's calculate the value of the call option now by applying the formula. Now the value of the call option. Now I remind you the formula. Let me remind you the formula before you go to our calculation. Now remember here what we said about the formula for D1. So we have explained the D1, how we calculate D1. We have calculated D1, and then after that we have calculated any D1. Then D2, we have done D2 this way. We have our D1. Then all this, we have gotten our ND1, our ND2. So you go back to your formula here. The formula is up here. So having known how to apply this formula in our solution, we go back to our final answer there. So you take value, you're saying value of the call option. We take that 5. Now that 5 is the price of the stock. Then you multiply by D1, our D1, ND1, that is, ND1, this 0.8438, which I have shown you. And then you minus, now this part here, that is the strike price. You divide by, this is exponential function, 2.7183. Now exponential function. Now how do I get it from my calculator? That one you can get from your calculator. Now somewhere here, now you press shift here, this button here, shift, or shift but alpha. Let me see whether it is that, whether it is the one with the alpha. Yeah, it is that button in your calculator with the alpha. Now this one here, this second button here, you press that, then you shift to this button here, that one, or that, I mean it, shift that way, then is equals to 2.7182, the E. So that number is coming from that. So that you're taking that, which is a strike price, divided by E raised to 0.1, raised to risk-free rate, multiplied by time, 0.75. 0.75 was time to expiration, which was 9 months here, divided by 12. Then if you work out all that, finally the value of the call option is 8 shillings 8.01. So basically that is how we use the Black-Scholes model to calculate the value of the call option. So this is our book for revision, that is derivatives analysis for CIFA. So you may want to solve out more questions concerning this particular subject. Our number is there, you can get the book, and you call me, I'll send you the book. You have more detailed questions and answers and solutions. Now I leave you with a question here which you can attempt. There's a question here you find in page 435 where you are told, consider an asset that trades at shillings, is no shillings but dollars, US dollars. Consider an asset that trades at $100 a day. Call and put options on this asset are available with an exercise price of $100. The options expire in 275 days and the volatility is 0.45. The continuously compounded risk-free rate is 3%. Required, calculate the value of European call and put options using the Black-Scholes model. Assume that the present value of cash flows on the underlying asset over the life of the options is $4.25. Number 2, calculate the value of European call and put options using the Black-Scholes model. Assume that the continuously compounded dividend yield is 1.5%. Now there is solution. I think we have done a solution for part 1. We still have solution for part of part 2. Now you can see, as we have done in the previous question in our discussion a few minutes ago. I've shown you how to calculate D1. You can see what we have done here is the same concept here. The same concept applies here. And then you get your D1, you use your table. This is your D1. You can use your table to get the value for ND1. D2, you just take D1, the one you have above here, then minus the denominator you have for D1 here. You get ND2 by reading from the table. Then you have said here using the normal probability table, you get your ND1 this way, ND2 this way, the value of the co-option, then this concept here all the way. Then part 2 is you have done here. So I think what you do is try to attempt that question as part of your assignment, and then try to see whether the answer that you get is okay with you. So again, I remind you that we offer CIFA studies, that is Certified Investment and Financial Analysis. You can contact us there. My contacts are there, 0727 871093. We still offer CPA, that is a Certified Public Accountants. We have classes physical as well as online. We still have books which you can get wherever you are. Now that is the end of our discussion for today. So we meet next time. My name is Mr. William. Again, my number is just down there, and that is our revision kit. Again, we still have study texts, which again you can use for the purpose of your revision. There are books like this one. For example, you have a book like this one, which is a public finance and taxation. It's a very good book for those who are doing the tax. So we meet next time. Thank you very much.